So today we'll discuss how to account for a number of things: current and long-term liabilities, bonds, the issuance of common and preferred stock or shares, and the purchase of them, cash dividends, and reporting and analysis of stockholders or shareholders' equity. I will refer to it as shareholders' equity for ease of use. So when we look at a set of financial statements, we want to look at a number of things, but most specifically, we want to know what kind of leverage a company has and how they're leveraging their debt in order to generate revenue. So debt becomes a really important concept for us because not only does it tie into revenue generation and asset acquisition, it also considers things like return on that debt or debt ratios or debt levels. And for some, it becomes a concern, but debt is manageable and can be manageable if cash flow is very effective. So if we look at debt versus equity decisions, debt versus equity decisions are, well, they normally form the basis of financing. So how do we acquire funds? Do we want to take on a loan, or would we rather raise money through a share offer? So we can either finance through debt or we can finance through equity. And so if we look at bond financing as an example here, we don't actually impact any shareholder control. We're not issuing shares, we're just taking on company debt through way of a loan or a mortgage. But specifically here, bonds. Bonds is really basically a promise to pay a bondholder back. They will lend us the money. There are market rates for this, and it's just a basic long-term loan, but it's in the form of a bond. So there's no voting rights attached, and there's control that's maintained by the owners of the company. Is there a tax saving? Of course there is, because bond interest is deductible for tax purposes. So we have the opportunity to reduce income, whereas dividends on shares are not tax deductible, and they're not an expense on the income statement. And if we have a return on shareholders' equity, it may be higher because even though bond interest expense reduces net income, the return on shareholders' equity is quite high under bond finance because we haven't actually impacted the shareholders' equity structure of the company. So we've kind of left it alone. In terms of whether or not we finance through debt or if we finance through equity, we'll first look at the debt side of things. So what is a current liability? Well, we've discussed this many times before, but this happens normally in the current operating period of a company, so within 1 year of the balance sheet date. So this is something we expect to pay. This is a current supplier that we have to pay back. It's a wages payable. It could be interest payable, taxes payable, anything payable within a current context, and it's within that 1 year of the operating cycle. So it's very straightforward. Whereas a notes payable is something a little bit different. It's almost like a note receivable that we spoke of before, where this has more of a formal arrangement or agreement. It's contractual. It's a written promissory note. And there is an interest attachment to it, so we would have to pay interest on this. And it's normally a short-term financing option. We don't want to engage in a longer-term financing arrangement beyond 1 year. So we would sign an agreement, we take a note payable, and we pay the interest cost for that to use for 1 year. So we can get these throughout the year for 1 year at a time, but we can do it throughout the year. So we have to make sure we manage this. Having a multiple number of notes payable issued and outstanding can be dangerous. We just need to make sure we manage it properly. So those due for payment within 1 year of the balance sheet date are usually classified as a current liability. But a notes payable is, again, something that's mostly current, and it meets the needs of current financing requirements. So for example, First National Bank agrees to lend $100,000 September 1st, 2017, if they sign a $100,000 12% 4-month note. So this is a very short-term arrangement. So when they issue an interest-bearing note, the amount of the assets it receives just generally just basically equal to the note's face value. So basically the lender will receive the main principal back from the lendee. So we have this impact on the balance sheet here of cash increasing because we're getting the money from our signer. And then we also have a notes payable. So we see here that, you know, we've increased our cash requirement, but we also owe that money back. As the interest starts to accumulate on it, every month we'll have an interest expense. So we see the 12% here. So no effect on income, net income actually, on the income statement as of yet. But when we look at the preparing the financial statements, we have to also think about, the interest cost attached to this bond, or sorry, note payable. And so if we prepare the financial statements, we have to think of what that interest cost looks like. So we look at the $100,000, it's 12% annual rate. So we're taking 4/12 of that because it was only 4 months worth of a loan. So $4,000 would be our interest cost associated with that loan or that payable. So again, no effect on cash flow, it's just a basic expense. Although the interest expense would have deleted our cash or reduced our cash by that $4,000 as we paid the interest and the principal back. So at maturity, this is where we'll see the cash impact. So we have to pay that face value plus the interest that's accumulated. So we'll record the payment as $104,000. We'll get rid of the payable off the books because we no longer owe it, and we no longer have that interest payable because we've accounted for it here in our cash payment. So if we look at that in terms of on the net income, we actually don't worry about that interest cost now because we accounted for it at the end of the prior year. So we accrued that interest up to the point of January 1st. And because it's a different year end, we had to do that. We're letting the investors and users know of the financial statements what we would be owing in the next period, which was the $4,000 plus the principal payment. Another common form of unearned revenue for specific industries like airlines are unearned revenues. This could also happen too, where a customer would like to make a deposit on an item and hasn't received it yet. That means that we still have this promise to pay. Subscriptions is another example, magazine subscriptions, etc. Is also an example of an unearned revenue because we paid for it up front, we just haven't received them yet. So if we receive the revenues as a company before we've delivered any of the goods or services, we actually do have the cash. We just have not delivered the service. We haven't completed that process yet or the transaction because we still owe it. So it's a liability. So any unearned revenue must become at some point earned revenue. So we'll just put it on hold in the unearned revenue account. So when the company recognizes revenue, for example, when the airline decides that, okay, it's your day to travel and you successfully reach your destination, then they've provided that service for you. So they would recognize the revenue. They take it out of the unearned pool and transition it from unearned to earned revenue. So they get rid of the liability and recognize the revenue. The examples given here, the airline, the magazine publisher, and a hotel. So a hotel is also a good example where you make the booking in advance, they take your money, and they haven't provided the service yet. So here's an example of a university. They sell 10,000 season football tickets at $50 each. It's 5-game home schedule. It's in advance. It's season tickets. The sale happens on August 6th. Completion of a game on September 1st are recorded as follows. So this is an example of any sport. You know, you buy things in advance. It could be the opera. It could be, you know, any other theater. It could be anything in advance. So we've spent the money already. We have this asset as a customer, but the company has to record it as a liability. So we have the $500,000 in cash. We also have unearned ticket revenue. So August 6th, we get the cash flow, and we have this unearned liability sitting on our financial statements now. So there's no impact on the income statement until we begin to incur any expenses in relation to servicing that request or servicing the game. So the $100,000 we see as becoming earned revenue rather than unearned revenue. So there it is. So we've just taken it out of one pool. So now what we'd see in the unearned revenue account is $400,000 in unearned revenue that needs to be converted to earned revenue as it becomes earned. Current maturities of long-term debt. What's really useful for a user of financial statements is to have a long-term liability separated into two components. And why is that? Well, I could go and look at the notes to the financial statements, and I could look at what the current portion due is in the upcoming year, but it's so much easier if we can do that in advance for the users. So we just separate a long-term liability into two parts, the current portion, which is the next current year, and the remaining part that is not due in the current year. So we're just looking at the portion of the debt that comes due in the current year. So it's just a nice way to present that for financial statement users. So in this example here, we have a construction company issues a 5-year interest-bearing note of $25,000 on January 1st of 2016. This note specifies that each January 1st, starting January 1st, 2017, they should pay $5,000 of that note. So they're recognizing that $5,000 will be paid every year until it expires. So when the company prepares its financial statements on December 31st, 2016, they'll recognize the current portion as a current liability of $5,000 and the remaining as a longer term future years liability of $20,000. We still have the full amount. It's just that we're recognizing a portion of it in the current term. Payroll and payroll taxes payable. So this is an example of well, one of the most common accruals and expenses for any company. Payroll makes up quite a large expense for most companies. And what we want to see here is this accrual. So if we see a payable on here, it normally means that the employees have incurred the wage, so they've earned it already. What hasn't happened yet is that the company hasn't paid it. So they need to indicate on the financial statements that there is a payment due or a payable. So users know there will be a cash outflow coming in the next period. So it's just good to know for users what that payment amount looks like. So these are, managerial, administrative salaries, any salaries payable, all the taxes associated with it, and any other payroll deductions like, for example, medical benefits. And that ends up with a net pay. So this is just really useful information for the users of the financial statements. So this company here, as an example, records its payroll for the week ended March 7th and payment of this payroll as follows. So when they're doing the financial reporting, they've actually incurred the expense, but they have not actually paid it yet. So it has to sit on the books as showing, as it's like a payment due. A payable is a payment due in the near future. So this is a current expense, or sorry, current payable. It will be an expense. It would have been expensed as it's set up as the accrual because it's been earned already. So the first transaction in accruing the amount has no impact on cash because cash actually hasn't been paid yet. What has been incurred is the expense. So we do recognize the $100,000 on the income statement. What we haven't recognized yet is the cash payment, which will be next. In terms of the accounting for bonds, bonds are a form, like I said earlier, of an interest-bearing note payable. It's very long-term. They can go, well, I haven't really seen a 5-year bond, but I suppose they are possible, 10, 15, 20, 30-year bonds. This is a long-term commitment for any bond holder. So most bond holders will be shopping around for a really good interest rate that's sustainable in terms of their investment perspective or expected return on their investment in terms of an interest rate. So ideally, a bond holder would provide the company with cash. I take the bond back. That's a promise to pay me back plus interest. And the interest is paid every 6 months. It's normally semi-annual. They're sold in small denominations, sometimes $1,000, it can be much larger. Governments, it used to be very common for our Canadian government to do this. They used to sell bonds as a way of financing. I don't know that Canada savings bonds are as popular as they used to be. Interest rates these days they're just so low that some people just aren't incentivized to put their money away for a long period of time at such small rates of interest. So it just depends on the type of investor that you are. So when they issue the bonds, it's borrowing money and it's a promise to pay back plus interest. As an example here, for 2019, the University of Toronto has on their financial statements as liabilities, you'll see that they have some accrued payables. So they have accounts payable and accrued liabilities and deferred contributions to their plan. They have a pension liability and long-term debt, note 7. So that long-term debt is obviously very interesting because it has a note beside it. So let's go and see what that looks like. So the University of Toronto really expands their disclosure in terms of what that long-term debt is. And as you can imagine, there's just no possible way of them fitting this on their financial statements, so they do disclose it through a note. And so they have a lot of series of unsecured debentures or bonds. So they have issued bonds in the past. So series A, B, C, D, E. And what they've identified here is under each of these series, they have an explanation. So they have a series or unsecured debentures bearing interest at 6.78% payable semi-annually, January 18th and July 18th, with principal amount maturing on July 18th, 2031. So if you look at the expiry dates of all of these bonds, you see 2043, 2045, 2046, and 2051. So these are very long-term bonds. So again, looking at the interest rates, you know, the current one at 6.78 is very attractive. And that's normally what has to happen, is that these rates have to be attractive in the long term in order to incentivize bond holders. So this is a really good example of disclosure. In the bond certificate, each bondholder will receive a certificate. It states the face value of the bond and the interest rate that's payable and the expiry date. Pretty straightforward, actually. So they'll record the bond transaction when it actually sells the bonds or buys them back, and when the bondholders convert bonds into common shares, which can be an option attached to the bond. Not as common, but it does alleviate some of the interest expense or the cost to the corporation, because it allows them to convert their bonds, which extinguishes them and the liability for the company, into common shares, which pay dividends, which is helpful for cash flow in terms of how the company and when the company pays that. Bonds can be issued at a number of different ways. At face value, which is, if it's a $1,000 bond, it's $1,000. Or it can be done at below face value, which is a discount, or above face value at a premium. And they're dependent on market activity. So if I'm going to issue a bond below face value at a discount, that must mean that I'm trying to incentivize investors to invest with us rather than outside of our organization. So the interest rates in the market maybe not as, or they might be really good, and we're trying to incentivize. So we'll issue the bonds at a discount. So for a $1,000 bond, maybe we offer it at $900. So you pay $900 in principal, even though it's a $1,000 bond, that's what it's worth. And your interest is based on the $1,000. So it's an incentivizing way of getting bond holders to buy your bonds. Whereas the premium is the complete opposite of that. So if we look at the premium, it normally is, that the market rates aren't as great. So we're going to incentivize you by saying, look, we'll pay you a higher rate of interest, and we'll sell it at a premium for you. So it's just one way of trying to, have investors buy your product. So this is a good example of the contractual bond contract. This is a rate of 10% as an example. And so if we say the contract rate of interest is 10%, and the market interest rate is 8%, 10% at par, or 12%, the market really does depend, or is dependent on how we issue our bonds, because this is how bondholders will respond. So bond prices respond inversely to the market. It's kind of an interesting phenomenon. So as market interest rates go down, which they have been recently, bond prices increase. So what they're saying is, you know, the market rate is really low, but we'll give you a higher rate of interest if you purchase our bonds. So it just depends on what the market is doing. So if the market rate is 8%, the contractual rate is 10%, we're going to sell them at a premium, okay? Because we want to incentivize investors to come and invest with us. Face value has no impact, and a discount. So even though the rate is 12%, we're going to offer you a discount. You can buy the bond for $900. We'll give you the $1,000 plus interest on top of that. So it's just another way of detracting from the market. Now, I don't expect you to convert bonds to premiums or discounts. I think it's just a matter of understanding how the prices are determined and how bondholders are incentivized. And for companies to issue bonds, it's just a way of financing with debt without having to go through a financial institution. So it's really just a way of, you know, avoiding the banking system. And perhaps maybe there's a reason for that. Maybe they want to look at more longer term. Normally financial institutions don't tend to go 30, 40, 50 years. So they're a little more limited in that respect. So issuing bonds at a discount, we can see here that this is how it would be presented. The sale of bonds below face value causes the total cost of borrowing to be more than the bond interest paid. So we have the $100,000 bonds payable less the discount. So we're carrying it at $98,000. So the issuing corporation not only must pay the contractual interest rate, whatever that ended up being, 10% as the example, for the whole life of the bond, but they also have to pay the face value rather than the issue price at maturity. So again, it's just a way to incentivize investors to invest with us rather than anyone else. So some companies don't like to take on debt. What they'd like to do is issue shares. They would prefer equity financing. So there's pros and cons of each. Of course, if we finance through way of issuing debt or acquiring debt, then we get the instant cash. We can use that for investment, but we also have to pay interest on that. That's the cost of borrowing money, the cost of doing business. And so it reduces our income because we have the interest expense, but it also increases our debt ratio and risk of solvency. So we have to be able to make sure we can manage that debt load. In terms of equity financing, the equity financing is quite a bit different. We issue shares, we receive funds for investors purchasing those shares. And so we get funding automatically, cash is increased. The only thing we don't get with this is the expense. We cannot expense dividends once they're paid. It frees up cash for a little bit longer. There's no contractual requirement like there would be for bonds or any other form of debt. And so we have a bit more flexibility with it. But if you want to keep investors happy, you should be giving them some form of return. And that would have to be in the way, most preferably, I suppose, in the form of cash dividends. Stock dividends are okay, but it dilutes the current ownership, which some companies prefer not to do. So an entity separate and distinct from its owners. So if I have a for-profit or not-for-profit, in most cases doesn't have shareholders. It's a not-for-profit. It shouldn't have any distribution of profit whatsoever because it should not be generating profit. It's cost recovery. If a for-profit company, you know, for example, you know, Facebook, General Motors, IBM, Caterpillar, you name it, is classified by ownership. Okay, so not-for-profits are classified by purpose, whereas for-profits are classified by ownership. So you're a private or publicly held company. Privately held company in BC, London Drugs is a good example of that. Purdy's Chocolate is a good example of that. There are a number of other privately held companies that we're aware of. And then the publicly held ones. Privately held companies make it a bit more challenging to determine fair value, whereas the publicly traded companies, fair value is available in the market. So how do we form a corporation? Well, in BC, it's quite simple. You go to the corporate registry, you follow the instructions, you apply for a name first. Once the name is approved, you get a number, and then you file your incorporation documents. You can use legal counsel or you can do it yourself. And they charge you a fee of $350 to do that. So The charter is basically the architecture of the company, and within that charter, you name the purpose of the company, the types and number of shares of stock or shares that are authorized to be issued, the names of the people that form the company, the current shareholders most likely, and the number of shares that they agreed to purchase at the time of incorporation. So basically the architecture, the bones of the company is what you would be doing. This is an example from the TELUS statements where the owner's equity is provided here. So liabilities, I haven't shown here, but I could have. But really just trying to focus on the equity section of the balance sheet. So the owner's equity, common equity is in millions, I think it was, and non-controlling interest. So you can see that they've reported it here, but they should also have a note to that, which they do. So note 28 talks about common share capital. And so what it says here is their authorized share capital is as follows. First, preferred shares, 1 billion shares. Second, preferred shares, 1 billion, and common shares, 2 billion. So in 2019, in 2018, it hasn't changed, but when they say they're authorized share capital, that would have happened at the time they incorporated, most likely. So what it means is the company is authorized to sell those shares. They're actually within the charter. So legally they can. What it means also when you see the terms authorized, issued, and outstanding, that's a little bit different. So if they've authorized the shares, that's great. What we want to know is how many are issued and how many are outstanding. So from that share capital, how many shares do we have issued in the market? And how many have we issued from Treasury, and how many of those issued shares are actually still outstanding? So the note here says that only holders of common shares may vote at our general meetings, with each holder of common shares entitled to 1 vote per common share held at all such meetings, so long as not less than 66 2/3% of the issued and outstanding common shares are owned by Canadians, Canadian company. With respect to priority in the payment of dividends and in the distribution of assets in the event of our liquidation, dissolution, or winding up, whether voluntary or not, any or other distribution of our assets among our shareholders for the purpose of winding up our affairs, preferences are as follows. First preferred, second preferred, and finally common shares. This is a really interesting statement, and it's true. The first 2 sets of shares are first and second preferred shares. Preferred shares do not, in most cases, carry voting rights. You purchase them for a little bit more, and what is attached to them in most cases, well, it has to be for preferred, is a designated dividend payment. So it could be 2 cents per share. So you are guaranteed a dividend. That is why you've invested in them. You're not interested in controlling the company or voting on the activities of the company. You just would like a dividend. That is your investment type. If the company does not declare dividends in the year, then those dividends on those preferred shares accrue. So for example, no dividends are declared this year, but they're declared in year 2. So if I have 2 cents per share on my preferred shares, I am now being paid in the year of declaration 4 cents per share, 2 from the prior year and 2 from the current year. That's the advantage of preferred shares. They do accrue, and it's a guaranteed dividend. Common shares, on the other hand, carry a voting right. So you can vote. They do not carry a dividend right. Dividends will be received if there's anything left over after paying preferred shareholders. So if you see preferred shareholders on a financial statement or in notes of financial statements, you know that they're being paid first. So as a common shareholder, you do get the right to vote, but you only get the remaining dividends should they exist. And that's fine. That's the risk you take. So what are shareholder rights? Well, you can vote in the election of a board of directors, which in TELUS's case is run by a board of directors. So you have the right to vote on who those people are. And you have a share of the earnings. So you do get dividends, right? As a preferred shareholder, you get 2 cents per share. As a common shareholder, you get whatever's left over. So you can keep the same percentage ownership when new shares of stock are issued. So there could be a preemptive right attached to it. That's very attractive because you don't want your shareholdings diluted. So it's a nice option to have. Another advantage for these types of shareholders is that you share in the assets upon liquidation, which TELUS disclosed very simply in proportion to their holdings. So preferred shareholders get paid first. If there's anything left over, the common shareholders will receive it. But in most cases, creditors are first and shareholders last. So I talked about this already about the authorized stock. The charter will indicate how many are authorized. If they've sold all of its authorized stock, then it must obtain permission from the province, in this case, to change its charter. So you have to amend the articles of incorporation. And if you decide that at first you're going to only authorize common shares, but you would like to have preferred shares or different classes of shares, then you have to amend the charter or amend the entire architecture of the company. So when we issue shares through a company, we can do it directly to investors or through an investment banking firm. Direct issue is typically the most common. It's easier in closely held companies or private companies, but the market would normally be the way of that for a publicly funded or publicly traded company. So different stockholder rights or shareholder rights come with different types of shares. So par and no par value shares. So par value is capital shares or capital stock that's been assigned a value per share. So at the time of incorporation, it would have had a value attached to it based on the number of shares, based on the number or the value of the investment. So par value determines the legal capital per share, and they must retain it in the business to protect creditors. But this isn't necessarily a requirement anymore, and it can be disclosed, it just might not be relevant. No par value is very common, and then most board of directors are fine with either way. So corporate capital, we look at two primary sources of equity: paid-in capital, common shares, preferred shares. And then what we look for is this paid-in capital in excess of par value. So this is more like, more than fair value, more than par value would be market value. So it's usually, if the company is doing well, the share price will increase, and then we have this extra contribution. Paid-in capital is the total amount of cash and or other assets paid to the company by shareholders in exchange for capital stock. So what did they use to buy it? So if we look here as an example, issuing par value common shares for cash, they have retained earnings of $27,000. So on the balance sheet, we would see paid-in capital, basically. Common shares of 2,000, and then in excess of par value of 4,000. So we're looking more at a market value increase. That's really what that represents. So how do we account for preferred shares? Typically, preferred shareholders have priority, like I said earlier, to dividends and assets in the event of liquidation, as TELUS also disclosed. And sometimes they don't have voting rights. It's possible that they do, but it's not as common. Each paid-in capital account title usually identifies the shares to which it relates. So we may have preferred or common shares. It's just easier to keep track of. So treasury stock is basically the amount that's authorized that sits in treasury, and we issue it out of treasury. Again, this usually comes in the form of whatever is stated in the articles of incorporation at the time we incorporate the company. So again, it's all legal documentation. So treasury stock is the company's own stock that has been reacquired by the corporation as being held for future use. We also call this contributed capital. If companies want to redeem shares from the market or from their shareholders, they can, and they contribute that capital back into the company. So they want to reissue them, or maybe they want to just cancel a class of shares and reissue new shares. They can do that as well. So there's lots of different reasons why companies would repurchase their shares. It's not as frequent. Actually, it's becoming more common than it used to be. So as a shareholder, what I would like to know is, what are my dividends going to be? That's usually why there's investment in shares. They want a return on their investment. So there's a couple of ways companies can do that, through cash or dividends. Cash dividends or stock dividends, sorry, or property. We won't worry about promissory notes because those really aren't that common at all. So dividends are generally reported quarterly as a dollar amount per share. It depends. It depends on the type of company. They can be declared in any way or form. So we talked about this earlier in the course as well, about when companies can pay dividends. And the only time that they can pay dividends are when three things happen. They have a positive retained earnings and a substantial retained earnings, because that's where dividends are paid from. They're earnings that have been retained over the years for future distribution to shareholders, hence the term retained earnings. They have cash, adequate cash, and the board of directors has declared the dividend. That's the most important thing. But those other two conditions have to be met before the board can do that. So recording this activity comes in a number of phases, 3 dates. December 1st, for example, here was the declaration date. That's where the board declares that a dividend will be paid, and they'll state the date that dividend will be paid. So the declaration date is different than the payment date. The board of directors, December 1st, says, we will pay a dividend for all shareholders of this class of shares that were shareholders effective this date or between this date and this date. And they've declared it. So what we have to do is we have to make a reservation for that. So we have to reserve retained earnings for the dividend that's just been declared. So we take that out of retained earnings right away through a journal entry. And then the date of record is what the board of directors would mention. So for registered shareholders are eligible for this dividend if they were shareholders from this date to this date. So in this case, they're saying December 22nd. So if you're a shareholder on record as of December 22nd, you will receive a dividend. The payment date is the actual payment of the cash or the payment of shares, whichever one they decide to do. In this example, we have the recording of these cash dividends. Remember, these are not expenses. The directors of this company declare a 50-cent per share cash dividend on 100,000 shares of $10 par value common shares. So that's what they would have paid for it. The dividend is payable on January 20th to shareholders on record December 22nd, 2017. So again, looking at those 3 parts. So December 1st, the declaration is recorded. So again, remember I said we have to reserve it. So we have to look at the payable, we set up a liability, and we also have to reserve those dividends out of retained earnings. No cash has been laid out yet. When the dividend is paid, cash goes down by 50,000 and the payable goes away. Notice we do nothing about the record date. We don't need to. It's just an administrative task that needs to be done so we can prepare payment for the shareholders on record. So what are your preferences for dividends? Well, it depends on the type of investor you are. If you want cash dividends every year, you might buy preferred shares. Okay, and if you want that, you want to be at the front of the queue to receive those, you would be a preferred shareholder. Usually the dividend is based on the value of preferred shares, a percentage of. They also come with cumulative dividend privileges, so dividends in arrears. So if they come with a 2-cent per share dividend, they don't declare dividends in the year. Next year they do, then you're entitled to $2 per share from the prior, sorry, yes, yeah, $2. $2 per share on each share from the prior year plus $2 per share for the current year. They have preference on corporate assets upon liquidation, possibly, and the preference may be for the par value of the shares or for a specified liquidating value. In this example here, it's quite a very detailed balance sheet. You wouldn't see this normally. All of this detail would be presented in the notes to the financial statements, but this is just giving you insight into how comprehensive this potentially could be. So you'll notice that they have, it would be shareholders' equity, and and then they're looking at the shares that are outstanding. So capital stock, they have preferred stock, they have common stock, but you notice the definitions that are issued beside them. So it's a par value of $100. That's most likely what they paid for it. It's cumulative, which means the dividends accumulate over time if they're not declared or paid. There are 10,000 shares that were authorized as preferred shares. Only 6,000 shares are currently issued out of the 10,000 and outstanding. So we get a sense of how many more can be issued later on. And then we have additional paid in capital. So this is anything above and beyond that par value that we talked about earlier. So in order to gain a more in-depth understanding and how to apply all of these concepts, I suggest you look at the Wiley Plus or textbook-based exercises just to reinforce your learning and understanding of these different bits and pieces of material. And then for your assignment number 1, you can please use the discussion board for any questions that you may have, or you can directly email me. So again, if you're you still have any questions, please feel free to email me. I'm happy to answer them for you. And if not, you can use the discussion board with your peers and also attempt questions and review the videos that are located on Wiley Plus.